Welcome to Firm Rate Facts. This is Anthony Meisner.
And this is Jim Merrion.
We're going to bring you your national update today. So let's dive right into the Fed forecast, the future, all the stuff you want to hear, right?
Let's do it. So, the Fed's been in the news quite a bit lately. Inflation is still a challenge. It's above that 2% that they like to have. We're at about 2.9, seen some estimates, maybe even 3.1, depending upon how you count it. So we're definitely not where the Fed wants to be from an inflationary perspective. So you'd think they'd want to hold rates as is, but we have other concerns.
We do have other concerns. Unemployment is still holding steady. So at least the rate of unemployment is not a concern, but one big concern is the job growth is stalling out dramatically.
Yeah, they're calling it a low hire, low fire environment. So not a lot of people are losing their jobs, but the amount of job postings way down, the amount of jobs being put out in the marketplace way down. So it's a challenge right now, anemic job growth.
It is. It's all kind of happening because of this. This is a study where they ask employers, are you going to be hiring? Right. And so you can see over the course of the years, it's really eroded down to 200,000. And that would be
employers have not been too excited to hire people this year. And this is a dramatic drop, obviously, from even just last year, less than half. So not to mention the glory years of 22.
Exactly. Well, I guess when you look at it from the flip side of the coin, we talk about, the average Americans, right? So when people are worrying about recessions coming up, what do they say? Well, right now, 74% of Americans admit that the world news and current affairs are affecting their decision making, and nearly 2 out of 3 Americans think a recession's coming.
And this ties into just the overall economic data that seems to show that all the growth right now in the economy is really being juiced up by the very wealthiest 10% or so of the market. They're continuing to spend. Everyone else seems to be pulling back.
All right, so let's talk mortgage rates because, of course, what affects real estate the most would be really getting buyers back into the marketplace. We're not going to do that without mortgage rates, but Fannie Mae released the most aggressive projection, and by the end of the year next year, they're saying 5.9%. Obviously, about middle of the year, we sat at 6.8. We've really come down.
Yeah, we're about 6.2, 6.3 today.
Yeah, so. Right about where Wells Fargo thinks the forecast is going to be at the end of next year. Mm-hmm. So that's not super optimistic. I think that's very flat. And then, of course, the MBA, who we look at a lot, 6.4. So they're actually a little pessimistic about what's going to happen in the future here.
Yeah, good news is we're getting closer to that below 6 level, but it's a long road ahead still. And that's where we want to talk for a few minutes now about what the spread is. And so Treasury yields is what you always hear when the Fed is raising or lowering interest rates. They're actually talking about the 10-year Treasury. Mortgages tend, over the last 50 years at least, to fall in unison with those. And so over time, the difference in percent is 1.76% over that 50-year tracking, but it's different nowadays.
Yeah, it's pretty dramatically different. But what the forecaster is really saying here is that the 10-year Treasury is going to come down over the next year.
And that's where it feeds into the projections for interest rates to be lowering. The yield is going to go down, so the interest rate there is lowered, and then the interest rate for mortgages should coincide as well.
It should. So why does this matter, Jim?
Well, we want to just explain to you guys that the spread between Treasury yields and mortgage yields or mortgage rates is high right now. So it's actually above that 1.76% due to several factors. Under risk, they view this as riskier debt for the United States. That affects future interest rates, and it also then increases the mortgage prepayment risk. So the market's perception of long-term inflation and Treasury debt supply has greater risk attached to it based upon current policy. So it's leading to higher costs for lenders to originate loans, basically.
It is. And so if you kind of compare what the current environment is to what a traditional environment might be, we'd actually be below the magic number, the magic 6% number.
Yeah, I mean, our difference right now is 2.1, whereas historically it was 1.76. So yeah, if we were at a typical risk level the United States has historically been viewed at, we would be doing great with interest rates.
Or at least better, right?
Yes.
Great isn't probably the proper word, but
I've tempered my expectations.
Temper your expectations. But, the average American public still says 5.5 is like that rate where things could break loose.
Yeah.
Right now, we are very bottled up, right?
Yeah.
And even at 6%, it definitely would be significantly better than it is today. Now, this graph kind of shows you, and green is good. We're in green.
It is, yeah. So right now, basically, as we get those lower interest rates dropping to, in that 6 level, we get into that decent part. And of course, below 6 is then when it becomes strong. And that's where historically people seem not to be affected as much by those interest rates.